Okay, welcome to our February edition of Wealth Wednesdays. And today we are talking about the buzzy topic of the 2026 market outlook. So our aim is for this not to be a dry economic discussion. We're really trying to pull in what we're seeing and how we're reacting to that, which hopefully is different from some of the reactions that you've seen. I know that I've seen a lot of very crazed, chaotic reactions, swinging from both sides, from like complete doom and gloom to, hey, this is our opportunity. And we're hoping that this is going to be a grounding session that's going to be really informative, and actually give you some steps that you might be able to take. And if you have concerns, questions based on what you've been hearing, please don't hesitate to go ahead and ask them. All right. So, Susan, I will let you go ahead and start a share. And just to reiterate, even though we will be sharing slides from time to time, this is so that we have some talking points. And for those of you who are visual, you know where we are, but we don't want this to feel like, a board meeting. So feel free to come off of mute and join the conversation.
All right. And we have to start with our disclaimer that this is for educational purposes only. This is not personal financial advice. Always do your own due diligence for your own situation. All right. So things are kind of crazy right now, right, with the markets. Predictions are all over the place, but I did want to go back and show you what 2025 looked like for the markets. It was a pretty volatile year politically here in the US, right? And we saw a big dip back in April. But overall, after that, things started looking up. And so overall, the S&P 500 was up almost 18% for the year. So if you just kept your money invested, you ended up well up by the end, right? Um, and so let's take a look at just in general how past events have affected the markets. And so this is from the 1950s up through the COVID period. And you can see all these different events. So we've got like the Korean War recession, we've got the Nixon recession, the oil crisis, the Gulf War, the dot-com bust. And you can see COVID here at the end. So you see these dips, but overall, the market still keeps going up. So are we in a position now where this is going to continue and the market is going to keep going up, or is something different happening now? That's kind of what we're starting to look at, right? Is this an epochal change that we're seeing now? And so what will 2026 look like? So I pulled some of the different headlines that have come up. So there's, the S&P 500 hasn't been this overvalued since the dot-com bubble. And then US stocks may outperform in 2026. Another strong year for stocks, right? Or this is the big crash that's coming. And so we see a lot of these forecasters are kind of all over the place, right? And even looking through history, typically forecasters, right? I mean, they make their money off of being sensational, right? They pick something and they make that forecast, and it's either right or it's wrong. And then they make a different forecast and it's right or it's wrong. And every now and then they hit one right, right? And they get a lot of followers. And then a lot of times they're never right again. So a lot of it is, we don't have a crystal ball, and neither do these forecasters, right? Like they are just trying to get your attention, right? By making these big claims. This will be the best year for the stock market ever, or we have a big crash coming, right? And so right now, it's kind of interesting to see what current events are doing to the market, right? So what you guys have probably noticed, gold and silver have been on this tear, right, all year. And that's because people are uncertain about the stock market. They're uncertain about the value of the dollar, right? They see potential inflation coming. They see other countries not wanting to buy US bonds anymore because of the way that our country is behaving and these tariffs. And so a lot of people have been buying gold and silver as a hedge against that. And then we saw the past few days, gold and silver have decreased in price significantly. And that is primarily because I think people are hoping that this new Fed chair, who's been named, Kevin Warsh, it's kind of an interesting name, Warsh. It's like I'm gonna wash my clothes. He has been known in the past for being very against inflation, right? But then there are other people that are kind of worried, okay, well, he's still part of the Trump administration and Trump wants rates lowered, which is going to increase inflation against. There's a lot of uncertainty right now, but people were confident enough that he's going to be able to handle inflation that they went ahead and sold their gold and silver that had gone up, right? So that's why we're seeing some of those prices coming back down again. But it's still showing that there is a lot of volatility out there. People don't really know what's going to happen, right? We've got a very unpredictable administration right now in the US, and we also now have our national debt equal to the GDP, right? And so what does that do, right? To our trade deficit, to how we fund our own government. I mean, we're spending more on that debt now than we spend on like Medicare, right? So there are a lot of uncertainties right now on what the US dollar is going to do, how much it's going to be worth, what we're looking at with inflation. But as in any year, right? It's no one has a crystal ball, right? And so I think, we have to go into it just not following random gurus online and these forecasters that are like, yes, this is exactly what's going to happen. This is the stock you need to buy. We just have to tune that out. We take it all in and say, okay, no one really knows, right? And go from there. And
Susan, this is Amy. I have a quick question.
yes.
Can you explain to me why the stock market does just keep going up and up? Is it because we're digging up and mining and getting more resources? Is it because people are inventing inventions that they can sell, and now we have things like marketing and CPAs, and why does it keep going up? Because that would help me think about if I think it would keep going up.
Right. And that's a really good question, actually. So a lot of it has to do with population growth, right? So, and this is one reason why you see this big movement right now, particularly with the billionaires, of increasing the birth rate because the birth rate is starting to fall. So if you want to keep growing your economy, you need the population to grow, right? You need more people buying things. You need a higher replacement than you have currently. And so we're starting to see the birth rate fall, and that will actually shrink the economy if that happens. And so that is a big concern, right? And so we are seeing more of this movement towards, oh, women, you should be having all these children, and we're going to take your birth control away, and we're going to take abortion away because we need more people to continue growing these companies and continue growing these profits and growing the economy. And Caitlin, I don't know if you wanted to jump in here too.
Yeah, I mean, I totally agree with that. That's a big factor. That's one of many factors that help strengthen an economy. And obviously, we know that there are many reasons why our birth rate is not growing right now, and there are a lot of economic factors that are driving that. As far as why is the stock market continuing to climb? I mean, you can argue that many economic factors are actually going in the opposite direction of the stock market, which makes it really confusing. We've been seeing we've just lived through a somewhat high inflationary period, and we're seeing grocery prices still really high. Necessities are still really costly, and things like childcare and healthcare are absurdly expensive. Higher education, and yet, why is spending still high? Why are people still overvaluing so many stocks? And the reason that is for one, a lot of that spending data is skewed. There's, the people who are making the top 10% in our country are the ones who are doing like 90% of the spending. So that really skews our spending data.
Yeah.
So spending data doesn't necessarily reflect our economy. That's not how we look to determine, do we have a solid economy right now? And then so that spending often will drive up the stock market, and then valuation. So corporate earnings have been trending pretty well overall, and that has not been correlated to unemployment. That actually correlates mostly to technology and AI. And so a lot of this can still very much be attributed to AI speculation and all of these companies who are investing more in AI, and they are putting their value, like, they're being valued very highly because of AI. And yet, we know that value is based on speculation as well. So, um, a lot of experts are still looking at companies and measuring markets, and still their bottom line is, markets are overvalued right now. They are overvalued. That will mean that we'll need to have some sort of a correction. That doesn't mean that we're going to have a massive recession. Doesn't mean we're going to go into a depression. But most experts agree that there has to be some sort of correction in our stock market, because markets are not reflecting what economies are telling us.
Yeah, it's interesting you mentioned AI. So, something we're actually seeing now is, in the past, um, an employer, say they would generate $100 for their company, they would see about $75 back in salaries from that. And now we're seeing it's more like $50. And the rest is going to stockholders. And so we're seeing, AI coming in and taking over a lot of that work. And the current workers are having to work harder, and the shareholders are getting richer. And so, like Caitlin said, we're kind of in this K-shaped economy now, where a lot of people the rich are doing well, right? Because they own pieces of these companies. They are the shareholders. And if you're at a point where for every dollar that's coming in, you get 50% of that just by being a shareholder, well, you don't need to work, right? Or you can do the work and get 50% of the money, right? Why would you want to be in that bottom part of the K? And so we're seeing this big economic divide now, right? Where these shareholders are getting richer and richer. And I think, with AI, they say, AI is going to come in and they're going to start doing all the work, and then people will just be spending the money. What I think they're missing is, where is the money now, right? If no one has a job anymore, then they won't have any money to spend on anything, and the companies are not going to survive. And so I think there is this big sort of black hole that I think a lot of these people are missing, right? When they're like, AI is going to save everything. And I think, sometimes they are proposing like a universal basic income to solve this problem. But I mean, there are all sorts of issues around something like that ever being implemented also. So I do think, to Caitlin's point, there is something building here, right? That's going to have to give as this K-shaped economy keeps taking off, right? And I think an important thing is to try to be on the top side of that K, honestly, to have as many assets as you can, right? And particularly like inflation proof assets. So things that will grow if inflation does come back again. So pieces of companies, real assets, commodities, things like that. I think that's really important. And this is more important now probably than ever before, just because of where we are at in the economy.
Susan, if I may again, this is Amy again. I just
Yeah.
wanted to say that I was at a conference recently for short-term rental stuff, and there was an economist who was speaking about 26 and 27, 28. He did kind of a 3-year thing, and he definitely talked about this K-shaped economy. And one of the takeaways that I have that I'm thinking about for our business is, I mean, sort of the recommendation was to try to offer budget rentals and then luxury rentals, you know,
Hmm.
to recognize that there's not really like a strong of a medium market now. And so, you know, we've just been thinking about that and what sort of like social equity sort of things do we want to try to, you know, how do we navigate that? So I'll leave it at that. But I just wanted to say that I've heard about this before.
Yeah, I think that's a really interesting approach. Definitely. If you have a business where you can stratify like that, start thinking about how do you serve those two different groups? Do you have, ultra luxury, but then also have, the affordable options? And I think we'll probably see even more and more of that stratification, unfortunately, as things continue in this direction.
And Michelle just asked in the chat, can we repeat what those assets are? And I'm not sure, Michelle, if you were talking about specifically Amy's example of short-term rentals that, you might.
What
Okay.
Susan said, because I caught Amy's.
Hmm. Yeah. So certainly having pieces of companies, so stocks, and then real assets like real estate, right, is somewhat inflation proof because rents will go up, values will go up as the value of the dollar falls. And then commodities, gold, things like that. That's really where you will shine. Cash is not going to be worth as much. Bonds we'll have to see. Bonds have been typically a pretty good place to keep your money. They're known as being pretty secure, kind of a cash equivalent. But these issues now with the value of the dollar falling and these other countries not being willing to buy US debt, we could see an impact on bonds from that. And, the fact that all these other countries in the world are willing to buy the US dollar has allowed us to run this huge trade deficit, right? So, China, for instance, right? So they provide all these goods for the US, and we're not providing the same amount of goods back to them, right? So there's this, it's unbalanced. And so to make up for that, they buy US bonds, right? So that makes up for that trade imbalance. And so they're buying our debt. If they stop buying our debt, then we have this huge trade imbalance and it starts falling, right? If other countries don't want to buy our dollar anymore, our economy is going to start falling, unfortunately. And so that's something we have to think about. And I think, with this new Fed chair coming in, people felt pretty confident that he is not going to let things completely fall apart, which is why gold and silver suddenly went down, because people felt more confident that, okay, I don't need to be buying as much of these hedge products, right? The gold, the silver, the real assets, because he's not going to let everything fall apart. So you see a lot of things happening right now just based on current events and how people are feeling. And that's kind of tricky, right? Like that's when things start being based on emotions and not really fundamentals. We see a lot more volatility in the market, and so that's an important an important thing to keep in mind right now. So I have this slide, how to handle uncertainty. So I wanted to just talk about a few different ways that you can set up your portfolio now. And I mentioned a few of these hedges, but I wanted to go over just some of the common portfolio allocations, and we can talk about them and then kind of talk about what you guys see and how you feel about your portfolios. So this common one, right, is VTI and Chill. You may have also heard VTSAX, which is the mutual fund version of this, and Chill. So this is VTI is an exchange traded index fund that tracks the total stock market in the US. This is what, if you've heard of the Bogleheads, this is what they typically propose doing. So you just put everything into VTI. It's got low fees, and you just let it sit there. You're invested in everything, right? And so the nice thing about something like this is if you look at the stock market in the past, typically it's only just a few top companies that generate most of the results, right? And so if you happen to be stock picking and you don't pick those companies, you may have been invested for a long time and had results that went nowhere or went down, right? So how do you pick those top companies every time? Well, generally it's by investing in either the total S&P 500 fund or the total stock market fund, right? You can guarantee that you've got those winning companies. And that's why this works, right? You're invested in everything. So you've got the ones that are going down, but you've got the ones that are the next, Google and Amazon, and you can make sure that you have those in your portfolio. So that's why this tends to work. It is like a buy and hold, right? And so if you've got a long runway for the stock market to go up and down, this is a great way to just set it and forget it. And, Fidelity did a study a few years ago on which of their clients had the best performing portfolios. And it was all people who had either died or they had forgotten that they had an account with Fidelity and they had just bought into the total stock market and left it alone and never did anything with it. They weren't buying and selling. They just went in there, invested and forgot or died. And so I think, there's a lot of merit to just taking an approach like this, especially if you don't want to have to be thinking about, what emotionally is going on with everyone in the market and even looking at fundamentals. This will typically work over a long period of time. Another one that is pretty common to see is the 3-fund portfolio. And so this is where you divide your portfolio into a US total stock market fund. So you've got domestic stocks, an international fund. So you get that international exposure, which right now probably makes a lot of sense, right? Because we're not sure what the dollar is going to do. So in the past, the US stock market has been like the big winner in the world, especially recently. In the past decade or so, we really have seen the US market outperform most other markets in the world. We're not seeing that as much anymore, right? Because the value of the dollar is starting to fall. And so now might be the time to really start considering international funds. And in the past, I've kind of felt like owning US stocks was good enough for international because there is so much international exposure within those companies. But now I'm actually changing my tune on that. And I'm starting to invest in more straight international funds and specific country funds like a Japan fund or a Europe fund to really get more diversification there. And then we also have bonds, right? And they have tended to be more secure. But as I said, we are not quite sure what's going to happen with those as the value of the dollar starts falling. But this is a pretty popular portfolio, and you can move these allocations around too. Like, you could do 50% US and 30% international and just 20% bonds. Typically, the longer runway you have, the less bonds you're going to want to have, just because they do tend to underperform the market, but they also tend to be more secure. All right. And now we're going to look at risk parity. So this is a newer type of portfolio. This is Ray Dalio's all-weather portfolio. And so the reason this type of portfolio was developed was for people primarily in retirement, and for people especially who are early retiring who want to be able to withdraw more than the standard 4% out of their retirement fund. So that's sort of been the gold standard, right? When you retire, you can take 4% out of your retirement fund for about 30 years, and you shouldn't run out of money. But people kept asking, okay, well, is there a way I could put my portfolio together where I've got different risk levels that offset each other so I could actually take, 5% or 6% out of my portfolio and still have enough money? And so that's where this portfolio came out of. So you'll see that it has things that offset each other, right? So it's got some large cap stocks, US stocks, also a lot of long-term treasury bonds, which tend to perform opposite of how the stock market is going. It also has some immediate term bonds. DBC is a commodities fund, and it's got gold. And so we're seeing a lot more people moving towards this as we're seeing more volatility in the market, right? And so, and I'll show you with my portfolio, I've started following something similar to this, right? So that I know, okay, if the stock market falls, I've got this whole other set of assets that are not going to fall. And so this helps people with sequence of risk returns. So if you happen to retire and then the market drops suddenly, you've still got assets there that are worth something that you can sell, and you don't have to sell your stocks at the bottom. Or vice versa. If you retire and gold falls or bonds fall, you don't have to sell those at the bottom. And so it helps keep your portfolio a lot more secure in retirement, and overall can allow you to have a higher withdrawal rate than you would have been able to have before. All right, this is another method that a lot of the gurus will promote. So tactical asset allocation, it's also known as trend following. And so the reason you'll see a lot of gurus promoting this is because it's always responding to trends. And so the purpose of this method is to try to predict what's happening in the future and change your whole portfolio to follow that. So for instance, they may have bought completely into gold a year ago, right? Or completely into international. And then now they're changing to something else, right? And so a lot of these gurus will promote it because they want you to follow whatever they are saying at the time. And so you can like subscribe, right, to what they're telling you to do with the portfolio. And so there's a lot of buying and selling involved. And there's also a lot of tax implications from that. So it doesn't tend to be very tax friendly because you're always buying and selling stuff, right? So you're generating capital gains that you've got to pay taxes on, and all these fees, buying and selling fees. But you will see this. So I did want to mention this because you do see this fairly often out there in the financial world.
And Susan, what I think is interesting about this is that 90% of the media that we see around economics and finance as it relates to how we should react as consumers, it all is about like the hype of what is the next big trend, or what is, the one security that, you should really lock in now to secure your future. And really what winds up happening is that all of these, we've already talked about a couple of different portfolio strategies, and those strategies do change over time, but it's not that we're looking ahead. These experts are not looking ahead to try and figure out what's the best portfolio strategy for retirees now. They're actually looking at data that has already occurred over the last several decades. So what Susan actually just showed you not too long ago in that, the all-weather portfolio, it doesn't reflect what we used to believe, which was that in retirement, people should then all of a sudden their allocation should have shifted to way heavier on bonds than stocks. And that's not
Mhm.
really something that people will subscribe to anymore. We're realizing that actually, bonds are not going, you're going to lose a lot of your return if you have a majority bond allocation. Whereas, if you continue to invest in the market, but invest in a more diversified way, you're going to be able to have the stability that we often used to look for in bonds while still being able to get returns from equities. So, the reason that people have come up with that portfolio allocation now as better than, pretty much following your age as far as what your allocation in bonds should be. That didn't come from somebody saying, here's a crystal ball and I'm going to try and just like nail the best allocation for future trends. It was coming from experts analyzing data that has already happened. So it's something that I like to highlight here too, is that we can really put in a lot of our time and energy and then ultimately our money and our assets into trying to, time whatever we think is going to be the best purchase, what is going to be like the hot new trend, when really, experts are truly, they're looking at historical data, and that's how, a lot of these big portfolio allocation recommendations, that's where they're coming from, is the historical data and not the speculation about the big trends that are going to happen.
Mhm. And historically, trend following has not performed as well as the market. So, and you'll even see, um, I saw this study where one of the big popular financial speakers went back and said, okay, if we had had a crystal ball, let's look at what the headlines were like during the COVID period and see, okay, would we have sold stock? Would we have bought stock? And even with the headlines, he didn't make the right decisions, right? He was like, oh, well, I would have seen this headline and I would have sold half of my stock in this. And by the end, he had way underperformed what the market actually did. Right. And so I think even with the crystal ball, it's really hard to predict because there's so much else going on, like with emotions, with other countries, just with underlying data, right? And so typically this trend following does not turn out well.
And Benet had a great question in the chat with, as far as the risk parity allocation that we just looked at, that all weather from Ray Dalio. What what about international? Especially given our previous comments where you said it, Susan, but I'm totally on board also with, diversifying into international markets. And, I have a much heavier allocation on international now than I ever have before. And it is interesting that Dalio's portfolio doesn't put an emphasis on
Mhm.
international.
Yeah, and I wouldn't be surprised if he goes back and does a revision now, with probably maybe even a little more gold and certainly more international. Like I said, the international has been underperforming for so long. I think a lot of people just kind of wrote it off. But now we're getting to a point where it does really have a place in a portfolio. So I wanted to show
Definitely.
you what I've set up, which is more of a risk parity type portfolio. And so this is for my taxable brokerage account. I will say for my retirement accounts, because I still have a long runway before I can access those, I'm still doing more of like a VTI and chill. Like I'll just invest those in the total stock market and be done with those, let them sit there. But for my taxable brokerage account that I actually am living off of now, I need that to not drop significantly while I am pulling down principal. And so I have about 50% of that account still in the S&P 500. And so through that, right, you're getting large cap top 500 US stocks. And so that's a way to make sure that, you still have these top performing, like AI stocks, tech stocks, you still have exposure to them. But that you also have other things too, right? And so I've got half of that. And then in the other half, I've got things that are going to perform differently than the S&P 500, right? So I've got a bunch of hedges here, this 30%. So gold is about 5% of my portfolio right now. I've got REITs, so that's real estate investment trusts, and I've got different types of REITs. So you can do just an overall real estate investment trust. You can do equity investment trust, you can do debt investment trust, you can do retail, commercial, multifamily. There's all different types of real estate that you can invest in. I've got some small caps, I've got some value stocks, and I've got a good portion of international now. And I really like VXUS. It's the Vanguard International Fund, low fees. You get good exposure around the world. But like I said, there are also a lot of funds that will focus on particular countries or particular regions. And those can also be a good option depending on what you're looking for. And then I'm also keeping a fair amount of bonds and cash right now. And I do have a new addition to my portfolio are the long-term treasury bonds, which I had not bought before because they do tend to underperform, but they also are a really good hedge against the market. So I actually have a decent percentage of those now. So I've got long-term bonds, short-term bonds, and then like a money market fund that I'm also, it's a cash equivalent, and I'm earning close to 4% on that. So that can be a good hedge, right, against the market if you're having to live off your money. If you're not having to live off your money yet, then you may not want to do a risk parity portfolio because it will underperform the market, right? Because only half of this is invested in the S&P 500. So if the S&P 500 goes up, 20% this year, only half of my money is going to be earning that. And so it will underperform the more hedged assets you have, right, that are on the other side of that. But it also is a lot more secure for the future. And so you want to think about, okay, does this make sense for my situation now? And also what your personal risk tolerance is. If you're okay looking at your portfolio and the market, is down 10 or 20% and you don't have a heart attack and you just sit there and you're like, okay, it'll come back up, then, you're probably fine having more exposure to the S&P 500 or the total stock market. But if you don't like seeing those things and you feel like you might make emotional decisions to sell, or you're not going to be able to sleep at night, then something like a risk parity approach like this might be better, because hopefully only half of your money would disappear at any given time. So it really depends on your personal approach and your personal risk tolerance.
Susan, I have a question.
Yes.
It's Amy again. I'm sorry if I missed this or misunderstood, but could you explain if there's a reason to do like some of the safer bonds compared to a CD?
Yeah. So a CD is a different type of product, right? So it's a certificate of deposit. And so it's a completely different type of product than a bond. So a bond, you're buying debt, right? And so a CD will typically be a lot more secure. It's typically FDIC insured through your bank, which is a big plus for those. Bonds, if you buy into a bond fund, they can be easy to trade. CDs typically, you're locked in typically for, you can buy short ones that are a month, but a lot of times they want to lock you in for 6 months or a year. But you can go either way on those. Really, it's a high yield savings account approach, right? Whichever one you take, whether you invest in bonds or high yield savings account or CDs, this is a place you're parking cash and you're trying to at least meet the inflation rate with that cash, right? I feel like that should always be a good goal, right? Is to at least earn what the inflation rate is, hopefully a little more, but at least get the inflation rate. And so your cash is not just sitting there eating itself. And Caitlin, did you have input on that?
Yeah, I would totally agree. I think it also makes sense to look at what is the rate environment at any given time too. CDs were a big part of my strategy starting 2 years ago and in the last year, but not so much anymore. I had a CD ladder because I was getting some good rates on CDs, and right now I find that that's not as lucrative a strategy just based on rates that I can find on CD versus even in my money market. And now if I'm doing some short-term bond ladders. So um, it really just, when we talk about cash equivalents, I mean, really the answer is the same for any question. I was just typing a response to Deborah about VYMI for an international ETF, and it's kind of the same, what sort of international ETF should I be looking for? What sort of like cash equivalent strategy should I be looking for? It depends on, what kind of work you're willing to put in. So I had a CD ladder, which means that I have CDs that are coming due, within a month apart of each other. And that means that it takes a little bit of overhead to set that up, right? And buy those CDs in the right increments. So there you can certainly say, forget that. I'm going to do a set it and forget it approach, and keep my money in a money market, or a bond fund, and not have to deal with that. And then same with like when you're looking at different types of ETFs and you're like, I want to have an international ETF. You figure out, do I want to track small caps? Do I want to track large caps? Do I want a higher expense ratio if it means that it's going to be more managed and potentially have a higher return? Or am I okay with maybe a slightly lower return, but like a much lower expense ratio? So all of these different factors are important for you to keep in mind. The VYMI, Deborah, in the example that you gave, that is a high dividend international ETF, which not all international ETFs are high dividend. So it's focusing more on international companies that are kicking out a dividend, and they're prioritizing that. So that could be great if you're looking for those dividends, but you might be an investor who says, you know what, I don't want to deal with the taxes of dividends. So I want one that's, not necessarily looking at high dividend companies. So that's my really boring response about it depends, but those are all examples of why, it really does depend, but also I want to be the voice that gives you permission to not worry that like, oh my gosh, did I make the right choice by selecting this international ETF versus that one? I mean, if you want to, you can even dig into the details and compare the two and say, you know what, the holdings are pretty much the same on these. And so I feel good about it. And, maybe the fees are exactly the same. And so don't keep yourself up at night thinking, did I make the right approach by choosing that one ETF over that one? I will say I do that to myself sometimes too. I'm like, ooh, that ETF sounds really great for tracking that market. And I'm like, you know what? The one that I have that is already tracking that market, it's fine. Like that's the one that I'm going to go with, and I'm not going to make any changes. And I'm here to give you permission also to not let that keep you up at night.
Yeah, I agree with that too. I have some VYMI in addition to my VXUS, and honestly, they're very, very similar in the returns. So VXUS is also paying some dividends, and I don't know, it pays like 3%, and then VYMI pays a little under 4%, I want to say. Like they're very close, actually.
Yeah.
But typically, what you'll see with the dividend stocks, right, is they are taking their extra profits and giving them out as a dividend versus growth stocks that are typically not paying dividends or paying very small dividends. They're taking their excess profits and they're putting them back in the company. And so what you'll see is sort of a contrast between those two stocks is, do you want to be taking these profits now, or do you want to be letting the stock grow, right? And it just depends. If you're retired and you're living off of that money, then yeah, you might want to choose more dividend stocks. If you don't need the money right now, then you might want to choose more growth stocks and just let your portfolio grow. You can also reinvest dividends too. You could just set that up to reinvest, but you will be paying the taxes on them. So that's the downside, right? If you just have growth stocks and aren't paying dividends, you don't pay taxes until you sell the stock. If you've got dividends coming in, you still have to pay the taxes, even if you reinvest the dividends. So it is something to think about. I see, Christy, you had a question. This is my taxable brokerage account. That's what this represents. So
Okay.
my overall portfolio still is, I would say, 60% stock market and 40% real estate. And that includes my alts, my private equity, and like the physical real estate I own. So I have 9 units, plus my house. So and it used to be higher in real estate. So it used to be probably 60-40 the other way. But with real estate values falling, my portfolio is actually shifting itself. It's not me shifting it. So I could potentially buy more real estate and rebalance, but I'm actually shifting more into liquid assets. I do want to hold some of those real assets for protection against inflation. But I also, because I am living off my portfolio, I feel like I can't tie as much of it up in non-liquid assets like private equity and alts. So that's just my approach right now.
Sure. With your real estate, these are like single family units. Are you involved in any syndications for multifamily or other self-storage, different asset classes that way?
Yes, to all the above.
Okay.
So I've got a fourplex, I've got 2 duplexes, I've got a short-term rental, and then I also am invested in a lot of commercial real estate. So multifamily apartment complexes, a hotel, some car washes, self-storage, mobile home parks, industrial. I wanted to diversify through all the asset classes.
Right.
And some of them have not performed well, I'll be honest. Some of them I'm going to lose all my money on. And so that's something I'm thinking about for the future, because that's a really bad thing to have happen when you're investing. You don't want to lose all of your money, because then you have nothing left to reinvest, right? So if you're in the stock market and the stock market drops 90%, at least you still have something there that you can just leave and hopefully it will recover. But if you lose all of your money, you can't do anything at that point, right? So that's kind of why I'm starting to shift more away from these illiquid assets into things that I have a little more control over.
Okay. Thank you.
And just to cover a couple more questions that I'm seeing in the chat, as far as strategies to develop income in retirement, why not go for, a disproportionate amount, or like, a heavy amount of dividend yielding securities. And Susan touched on that a little bit, but one thing that I would also say is it often tax treatment on dividends is a lot worse than capital gains, long-term capital gains. So although psychologically it's harder for us to think about selling positions that we have, but that is why we purchase these positions in the first place, right? We want them to grow in value over time, and so that we can then cash in on them in retirement or when we need them. And cashing in on it means we're going to sell a portion of those positions. And often when we do that, we can select what are the positions that make the most sense for us to sell right now. And to be able to use long-term capital gains actually has better tax treatment than dividends. So that's why you don't necessarily see people just shifting to an all-out dividend approach in retirement, because one, those dividends aren't guaranteed. Two, the dividends that you do have might represent that your positions are still not growing as much. But three, also, you might not have as the tax treatment that is as favorable than if you were to just say, rather than look for dividends, I'm going to just, have equities that have been sitting in the market for a long time, and now I'm going to sell those and be able to use long-term capital gains for my retirement. So I just wanted to touch on that. The other thing is, what bonds would you suggest for a bond ladder? I would say, Michelle, that really, it depends on your timeline, but the idea of a ladder is to set it up so that you have money or bonds or CDs that are maturing at different times, meaning that that money is becoming available at different times. So you might look for if you want to know that you have money available every month. Like I mentioned, I had a CD ladder that each CD was maturing a month apart. You can do the same with bonds, or you can look for larger increments if you're like, I don't necessarily need to know that the money is coming up every month. In fact, I don't want that much work for myself because I don't want to figure out what to now do with that money now that, I have a bond maturing. So some people will look for longer intervals, and that's what makes up a ladder is really, it depends on that duration. And then as for money markets, I mean, usually if you have a brokerage account or if you are putting your money somewhere like in a Schwab or a Fidelity or Vanguard, often, whatever money market, there are usually different money market funds that they have that are paying probably pretty competitive rates, especially as compared to whatever a high yield savings account might be. I know that I use the Fidelity government money market most of the time. So um, I don't necessarily have one single recommendation for, the best money market out there. I think it's another one of those things where you can look at your own brokerage and figure out like what are the money market options that I have here, and you can figure out like, is there one that has fees? Is there one that's yielding more than the other? And you can make that choice based on whatever's
And
easiest.
something, that I like about Fidelity is that it sweeps your cash into their
Yeah.
money market fund, SPAX, SPAXX.
Yeah.
So you'll automatically be earning whatever cash you have sitting in your account will earn through that money market fund. Schwab does not do that, which is a little frustrating. You have to manually go in and move your money. And I put in here SWVXX is one of the main ones at Schwab. And they're earning, I think, upper 3% now, close to 4%. And then short-term treasury bonds, so like SGOV, is also, it does typically perform about the same as these money market funds. So it performs like a cash equivalent account also versus, intermediate bonds or long-term treasury bonds. All right, Caitlin, I want to make sure we get to your approach, since your approach is a little different than my approach.
Yeah, it's a little different. I know, like we like when we could talk about the differences in our investing approaches, because I hope that for one, it shows you that there's no one size fits all. And a couple of the differences that I'll spell out here. One is that mine is it looks a little bit more complicated, but really I just always think about it as I look at small cap versus large cap, meaning like what size companies are you invested, small cap versus large cap. I don't focus much on mid cap. There is mid cap, but I feel like I have my portfolio diversified enough if I've got holdings in small companies and holdings in large companies. And I find that mid cap is a little bit redundant. So I usually just look at small cap and large cap, and then US and international for those. One thing I'll say is that my allocation has been changing because now I'm in more of a position where I'm living off of some of my retirement. I depend on my real estate income as well, but we are in a position where our portfolio now has a different role for us. It's not just growth and more risk taking. It's now in a position where it's starting to have to provide for us if we need it. So my small cap allocation is shrinking compared to my large cap allocation. So what you see here actually represents a little bit of a transition. So I am expecting my small cap allocation to continue to get smaller and smaller, my large cap allocation to continue to grow, and that's true for US and international. My emerging markets is like my riskier, that's my hedge, where I don't invest in gold. I always have felt like we have a pretty heavy real estate portfolio, and I'll, kind of look for other assets in the emerging sector, and that's kind of like my risky investment, but also the investment where I find to be that tends to be what performs when other sectors are not performing. Bitcoin is on here with like a big caveat. This is only very recently that I've started to explore Bitcoin in my like emerging sector here. And really, that has a lot to do with what's happening with our currency. And I find that like there have been trade deals happening that are no longer in US dollars. And I think that that is very telling about our currency, which always has, for the last 80 years, has been the gold standard. And as countries are starting to recognize that our debt is so huge now, it's as big as our GDP. I think that's a red flag for a lot of investors. Other countries are starting to move out of US debt, which honestly is not going to make a huge ding in terms of the investors that our government needs for its debt, because mostly it's coming from here in the US. But I think that other private investors here in the US are going to pick up on that. And I am looking at, okay, well, what does that mean if our US dollar is not as strong a currency as it has been? And I do think, I'm always hesitant to talk about this, but I think that that means there could be some growth in Bitcoin. So I am not someone who would ever say, go out and buy Bitcoin. This is sort of like my way of just saying, I'm experimenting here. This is totally a hedge. And it's definitely not something that I'm sinking money into that I'm not okay with losing. So usually it doesn't have a place on this chart, but it's something that has snuck into the emerging sectors in my allocation here. But my international allocation is growing also. So, historically, I was like, maybe I'll even invest in like 20%, 30%, or 10 to 15% international, and that's growing now. It might even be getting close to like 50-50 in the next 10 years, but not yet. So I'm slowly making some of those moves. So that's what my allocation looks like. And I should say too that because I own a lot of real estate, that does affect some of my decisions here too. And this obviously doesn't account for my real estate portfolio, but my real estate portfolio has provided cash flow. I really like having it as a way to hedge against inflation, but also in where I am in life right now, I don't want to be as actively involved in some of that real estate. I want to have more liquidity. So we're also transitioning our portfolio where it used to be 60-40 real estate to public equities. That's now shifting, and we're probably going to get it flipped here in the next 5 to 10 years, and it would be more 60% public equities, 40% real estate.
That's interesting because that's just what I said about mine.
Yeah.
And you and I don't talk about this that much.
I know, that is funny. I
Um,
was chuckling when you said that.
I'm curious about your exposure to small cap. I mean, there's a lot of
Mhm.
small cap in here, and I
Yeah.
I feel like small cap has generally underperformed, but I'm curious to see what you're thinking with that and that pretty big exposure to small cap.
So actually, my inspiration for this allocation is the Paul Merriman four fund portfolio.
Mm.
And he actually, compared to like the VTI strategy, people who incorporate small cap into their portfolio have seen like much more significant growth over
Hmm.
20, 30 years. So certainly in certain periods, especially like what we've just seen, our large cap has like been out of control. Small cap tends to be a little bit more reliable, but then there are spikes where I've seen a small cap portfolio. There's like 47% growth in so many years. And so I just find that small cap gives you that exposure to be able to benefit when there is big growth in small sectors that people are not predicting. And I do like the idea of having small cap in my portfolio, but that is, like I said, the area that's shrinking a little bit more because large cap tends to be less risky. And so I'm having more and more large cap exposure as I get wiser and older.
I'll be interested to see how this performs over time, because I do think, we have seen a lot of large cap growth, and so it
Yeah.
could be time for small cap. But then I also feel like, okay, well, all those big companies that take off to the moon, they're all typically in large cap. So this will be interesting to see what happens over the next few years.
Yeah. And the idea around small cap too is that you just don't see, it's not the same level of volatility. So you don't have the dips. You're not, as long as you're exposed to small cap, your portfolio is not going to take the big hits that you would if you're in, all large cap.
Mm-hmm. I know we're close to time. We have a lot of people dropping, so just want to end here with a few things, a few tips what not to do and what to do. So what not to do: try not to make emotional decisions. Try not to time the market, because we talked about how even if you have a crystal ball and the headlines, a lot of times you're still not going to do the right thing. And then try not to mindlessly follow the forecasters. They're just making guesses, just like you and I, right? And so try to stay educated, right? I'm not saying don't listen to them, but don't just mindlessly follow everything that they say. And so the big takeaways are that no one has a crystal ball. Set up a portfolio that you feel good about and will help you sleep at night. If that means adding more hedges in so that it kind of balances out the risk, that may be a good approach for you. And then always stay diversified, right? And that can be even, investing in VTI, and that's your only thing. You get a piece of every single company in the US stock market, right? That's diversification right there. So just stay diversified. Don't put all of your money like in one particular company. That's extremely risky. So stay diversified and set up a portfolio that works for you and your situation, your risk profile, and your time horizon. And Caitlin, do you have anything else?
I think you nailed it. Thanks for everybody who was able to join today. I hope this has you feeling a little bit more confident about your strategy, especially if your strategy means I've already set my allocation and I'm just going to sit back and watch what happens. We're here to tell you that you are totally allowed to do that, and that is often the right approach. So hope everybody has a more of a calm mentality now in the 2026 markets.
All right. Thanks everybody for being here. And we'll see you next month to talk about the real estate market outlook for 2026. Yep. So I hope you guys can join us. All right. Thanks. Bye.
Thanks, everyone.